In the early 2000s, America looked unstoppable. Homes were becoming more expensive every year. Banks were making billions. People with normal jobs suddenly owned multiple properties. Everyone believed one thing: housing prices could never go down. And that belief became the foundation of one of the biggest financial bubbles in human history. Banks began giving mortgages to almost anyone. No income? No problem. Bad credit? Doesn't matter. Some loans were so reckless. They were called ninja loans. No income. No job. No assets. But here's where things became dangerous. Banks didn't keep these risky loans. Instead, they bundled thousands of mortgages together, turned them into fancy financial products, and sold them to investors around the world. These products were called mortgage-backed securities, and Wall Street treated them like gold. The system became one giant machine built on debt. The more loans banks created, the more money everyone made. Until eventually, nobody cared whether borrowers could actually pay. Because by then, the risk had already been sold to someone else. Section 2, The Cracks Begin, 230. Then something unexpected happened. Housing prices stopped rising. At first, nobody panicked. People assumed it was temporary. But millions of Americans had adjustable-rate mortgages. Their monthly payments suddenly exploded. Defaults began rising. Then foreclosures. Then panic. The safe mortgage investments banks had been selling? They were suddenly toxic. And nobody knew how much they were really worth. That's when fear spread through Wall Street like a virus. Banks stopped trusting each other. Huge financial institutions were secretly drowning in bad debt. And then, September 15, 2008. Lehman Brothers collapsed. One of the biggest investment banks in America. Gone overnight. Employees walked out carrying boxes. Traders stared at screens in disbelief. And global markets entered freefall. But Lehman wasn't the real danger. The real danger was what H.